time to be looking for opportunities in a changing market in a more cautionary environment. And hopefully my comments this morning will convince you all that there is still opportunity to be had in the markets today. Alternative investments do offer something that traditional asset classes do not. And there are ways to gain access to those market opportunities even in an environment that perhaps is towards the end of a business cycle. So I'm James Mellors. I lead the alternative specialist team at BlackRock. We're the world's largest asset management company. And here in Asia, we run over $20 billion in assets for alternatives for our clients. And as you'll see later, close to $180 billion in alternative investments globally for our investment clients. In terms of the environment that we're in, I'll start by giving a few context data points. So as we've heard, the world is changing and certainly becoming more cautionary. And as investors have been traditionally investing into traditional market assets, they've enjoyed good returns, both from equities and fixed income. But also, as we've heard earlier, we've seen a lot of money flowing into private markets as well. And that's been driving prices up across the board, but it's also been driving returns. You can see on the first chart here on the left-hand side, the returns that we've been seeing for the last 10, 15 years from private equity versus public equities, a significant premium driven by private markets exposure. And also from the private debt space, we're seeing an attractive yield from those assets versus the public markets. And as we look at traditional asset classes and we look forward to the next 5 years in terms of return expectations, the right-hand chart shows you our expectations. These are BlackRock's expectations for traditional 60-40 equities and bonds returns in the next 4 or 5 years. And you can see the returns are expected to fall pretty markedly. And that's making it ever more challenging for you as investors to hit your investment return targets. And as a result, you're having to look for new areas of investment opportunity. This is made harder still when we look at the correlations between traditional asset classes, in this case, stocks, government bonds, high-yield bonds, real estate investment trusts, REITs, and commodities, against the US equity market, the S&P 500 in this case. And what we've seen across every one of these asset classes since the financial crisis is an increase in the correlation between these asset classes. Traditional portfolio management theory of diversification across asset classes has been challenged by this increase in correlation. Now you may ask, what is driving this increase in correlation? Well, certainly since the financial crisis, quantitative easing has driven a lot of this. Governments have been buying government bonds. It's forced other investors into corporate bonds to seek yield, and that's driving pricing up in fixed income at the same time that we've seen a continued bull market recovery in equities. But as we know, that market is coming to an end. We're expecting to be towards the end of a credit cycle, and there is caution in the equities markets and increasing volatility. So alternatives has a role in this environment. And I think that's been borne out when we look at allocations into alternative investments over the last few decades. If you look back in 1997, the allocations to alternatives were actually only at around 4% in a traditional global pension fund. And as we've seen investors start to allocate more, that allocation has risen and now stands at around a quarter of a pension fund portfolio, 25%. And indeed in endowments, often it's much higher than that. So with that, there's been an increase in capital raising across the market. And if we look at how private market fundraising has increased over the years, you can see it's been a steady increase year on year, really capping out in 2017. And you'll see that the largest proportion of this has come through private equity. And certainly those of you investing into private equity and buyout in particular will have seen the steady increase in size of the mega funds. The winners are getting bigger. It becomes a winner-takes-all environment. And certainly that's been driving this level of increase. But it's not just in private equity. We're seeing the same in real estate. We're seeing the same in infrastructure as well, as people are looking for yield and looking for alternative sources of return. When we see that translate in terms of dry powder, of course, if money is flowing into the asset classes, we're going to see dry powder increase. And as has already been mentioned earlier, the incessant hunt for return has driven dry powder levels to record levels now. We're seeing over $2 trillion of dry powder in the market today, and as you can see, over half of that is in private equity. So it's becoming more challenging to find opportunities that are going to hit your return targets. The competition is fierce out there. And I think when you look at the environment in the context of $2 trillion of dry powder, it really does bring your mind to think about how can I still get access in that kind of environment when there's $2 trillion of competitive capital seeking the same opportunities that you are and I am as an investor. So what does that mean for us as investors today, and how can you continue to gain access to this space? Our view is that the increase in allocations and the increase in dry powder is really driving a need for scale operators in the alternative space. Traditionally, we've seen people focus on boutique managers, looking for star manager skill, seeking that niche player who can really drive returns. But even that niche player in today's market is going to struggle to find opportunities when there's $2 trillion of dry powder out there. If you look to a scale manager who can provide you access to alternatives in scale, they provide you three key things. The first is sourcing power. They have bigger reach than anybody else in the market, and they see the most opportunities out there. That's going to be critical when it comes to sourcing good opportunities and sifting what is becoming an increasingly difficult market to find good opportunities in. If you have scale, you have the ability to negotiate on pricing. In this environment, competition is fierce, and if you're able to drive pricing through your scale, then that's going to give you a competitive advantage. But also through scale, you can put more money to work and deploy efficiently, and that equally will create opportunities for scale operators to put money into the market versus boutiques who can only place smaller tickets into opportunities. With that in mind, we're seeing investors start to pay perhaps less attention to the boutique managers and look for those managers that can aggregate scale, but also provide them solutions that combine multiple areas of alternatives into one portfolio, provide consistent analytics, risk management, cash flow management around that portfolio construction as well. But we're seeing, with the alternatives industry maturing, a number of key themes coming through as well. There are regulatory changes. Since the financial crisis, with the likes of Dodd-Frank, Basel III, Volcker Rule, all of these regulations that have been put in place to challenge the old world and really focus the mind on risk management, provide challenges for all of us investing today. Here in Korea, with insurance companies focused on regulatory change, it provides new challenges today. So, you have to be moving with the times, and you have to look to find ways to invest in the context of those regulatory changes. Investor scrutiny is becoming ever more greater. We're seeing an increase in due diligence from our investors, more so than ever, in terms of the investment attention that they're paying to the investments that they're making, and that is absolutely the right thing to be doing. But again, that requires us as GPs and managers to be cognizant of the level of detail that our investors expect and want when they're underwriting investment opportunities. There is fee pressure in the industry. Small players are going to come under pressure. The 2 and 20 model of old, unless you're at the very top of the tree, is going to be a difficult model to hold on to. And increasingly, scale operators can put pressure on those fees and bring actually our investors the opportunity to invest with more efficiency. Technological innovations are coming through in alternatives as well. If any of you are running alternative portfolios today, one of the challenges is understanding your portfolios and understanding the risks that you're taking within those portfolios. Technology is driving change and is driving people's ability to analyze the risks they're taking and understand their portfolios more holistically. And again, scale operators who have that technological advancement can help their clients with that technological innovation. And then lastly, in terms of complexity, the world is becoming more complex. there are more asset classes to think about, and blending those asset classes takes more thought and more precision as you're looking to build your portfolios. Again, it's harder and harder to juggle that in-house. Think about using scale operators to help you and be an extension of your investment teams to help you understand that complexity and source those opportunities. So what are we seeing in terms of investor sentiment? The chart you can see on this page looks at BlackRock's investor base in terms of sentiments towards alternative investments. And this is a 2009 survey, and you can see, even in light of those cautionary comments that I've given, actually, in many areas of alternatives, we're seeing our investor base expect to increase their allocations to private markets, whether that be in private equity, real estate, or broader real assets. We're seeing allocations increase significantly or slightly to alternatives. Even hedge funds that comes in for some challenges and has had a few years of challenges, there are investors expecting to increase their allocations there as well. And with that, you know, I guess the investor universe is also expanding in terms of what you can invest in. If you look back to 1985, really, the alternatives landscape was made up predominantly of private equity, a little bit of private credit, a little bit of real estate, but very little else. And as we've seen the alternatives universe evolve and mature, that has changed. And as we stand here at the end of 2018 into 2019, we've seen that pie diversify still further. And this is looking particularly at the private markets exposure. Buyouts, venture capital still make up a significant proportion, but you can see real estate, infrastructure, private credit have all grown in terms of their share of the pie. And our view is this is going to continue as investors continue to look for yield, and investors continue to look for growth and diversification. So I mentioned three themes there. Many of you, as you look to alternatives, probably have these three themes in your mind in terms of the outcomes that you're looking to drive: income, growth, and diversification. And when you look across those different asset classes in alternatives, you can see that many of these asset classes tick all three boxes, but actually virtually all of them tick at least two of these boxes. Most of the conversations I'm having with clients about alternatives today fit one of these three themes, or indeed often all of them. And our job is to help our clients navigate that increasingly complex landscape. Some of the questions that we get from our clients as they're thinking about this complexity, I've listed on the position below. It's getting harder, more complex. Do investors have the talent within their organization to source and manage those opportunities in an increasingly complex environment? Are we resourced adequately to manage an increasingly large portfolio of alternative investments? Can we monitor all of those managers in one go, or do we need help? Do I have the right technology, as I alluded to evaluate the risk across that portfolio? Does my investment committee or my board understand the opportunities that we're putting in front of them today? They're becoming more complex. Do they have the alternatives expertise to understand and assess those opportunities? And also liquidity. You know, do I have enough liquidity in my portfolio? Am I taking too much liquidity in my portfolio? Should I be taking some illiquidity to try and drive some illiquidity premium out of my returns? So how can BlackRock address this challenge? BlackRock Alternatives today represents just shy of $180 billion across multiple asset classes. And you can see here the key four pillars that we represent: hedge funds and hedge fund solutions, roughly 50 billion, real assets, well over 40 billion in real assets, both real estate and infrastructure, private equity, close to 20 billion, and private credit getting on for 27 billion. We have a very diversified book of alternatives within our house. We're very fortunate. And the pleasure that gives me is I can sit with any of my investors and talk to them about the entire alternatives landscape without having a bias to one area or another. I can be agnostic. Our job is to provide solutions to our clients and help them with those challenges. So as we look at that with that backdrop, where do we see opportunities? I've really highlighted four key themes here, and I've probably got more slides than time, so I won't go through all of these in detail, but you can see the four key buckets that we see as opportunity in today's market. The first is private credit, be that middle market lending, direct lending, be that real estate debt, infrastructure debt, or indeed opportunistic or special situations. We also see an opportunity in infrastructure today. There are some mega trends that were mentioned earlier around the need for a focus on infrastructure, renewing aging infrastructure, whether that be roads, whether that be ports, whether that be energy facilities, all in need of regeneration and rebuilding across the world. Value-added real estate. There's been some mention already today around core investment. Pricing is getting hot in core investment. If you're looking at real estate, you've got to look at how you can drive returns in a world where beta is not necessarily going to deliver that return. And then finally, private equity. Our approach to private equity is a little different, and I'll touch on a couple of areas as we think we can provide something alternative in the private equity space for our investor base. So quickly, private credit. What's happening? Well, private credit clearly has been on everybody's minds over the last few years. There's been a secular shift in the lending market. Banks are pulling back. Globally, banks are pulling back. They're being increasingly selective on who they will lend to and what they will lend on. And that's creating a gap, a financing gap in the market that investors are there to be able to fill. And we can help our investors with that. Increasing regulation is driving that challenge, whether it's Basel III, as I mentioned, or other regulations. There's also a cyclical shift. We're in a late stage environment now. And whilst we don't believe we're at the point where we're going over a waterfall or a cliff, there are opportunities that may arise from mini cycles or bumps in the road where you can take advantage of opportunistic trades in the private credit space. But also there are technical drivers. We're seeing increasing volatility and we're seeing that banks can't serve as the capital provider that they used to. So what can you invest in private credit? There's a lot on this page, so you won't be able to necessarily read it all, and I'm certainly not going to try and cover it all today. But it's important to give you some context to how diverse the space is, whether it be real assets-backed lending in real estate debt or infrastructure debt, whether it be direct lending to small and medium-sized companies who can't tap the traditional capital markets for capital today, whether it's mezzanine, or opportunistic or distressed debt. Each of these opportunities brings you something different, and depending on your risk-return appetite, any one of these different columns may fit your needs in terms of returns, in terms of tenure, and of course in terms of risk as well. So where can you play in the capital structure? Well, by very nature of this diverse space, as you look at a capital stack, you can invest pretty much across the board when it comes to private credit. Typically, middle market lending funds will be in the first lien or unitranche position. Real estate and infrastructure funds often will play in mezzanine or high yield as well as investment grade space. And as you're looking to the more opportunistic special situations and distressed, really they can play across the full spectrum and are driven by the pricing opportunity that they see in the market today. Here's an opportunity, I'll just touch on it very briefly, that we invested in within our US middle market strategy. This was a pharmaceuticals company that actually creates nebulizers and provides for the healthcare system in the US. Small company, but a very important company in what they do. We were attracted to this opportunity because they couldn't tap the traditional capital markets. They have a pretty much an oligopoly position in what they're doing, but nevertheless needed financing to grow their business. We had an opportunity here to provide 25% loan to value first lien financing, actually at LIBOR plus 875. Pretty attractive return for what is a very senior position in the capital structure of this company. Why is this here? Why can we do this? We have great sourcing networks within our firm. We have direct relationships with over 400 companies in the US. We have a great capital markets team that can source opportunities from the street. We're the largest counterparty to most of the banks. We see deal flow. And this is the kind of opportunity that comes to us time and time again. Not every opportunity is an attractive opportunity. Having a rigorous process and being diligent on your due diligence is critical to that. Real estate debt. This was an opportunity in a building many of you might be familiar with. It's what used to be called the John Hancock Center. We had an opportunity to acquire a mezzanine loan in this building, totally off market. This was a $45 million position, mezz position on a tranche of the building with the car park as well. structured with a coupon of LIBOR plus 525. But as you can see here, in terms of the capital structure, our last dollar exposure to this deal was actually 68% loan to value. So we've got over 30% equity cushion beneath us in the capital structure, providing us downside protection, and yet we're still delivering a return north of 7.5%. And finally, infrastructure debt, a gas-fired power plant. This is an opportunity that we sourced for our high-yield infrastructure debt strategy. Again, 7-year term, 4.5-year average life with amortization, 10.8% yield to maturity in Mexico. How did we source this? We have a Mexican infrastructure team that has the ability to source off-market transactions, and we had a great opportunity to work with the sponsor bilaterally in a relatively limited competitive environment to provide them financing on this deal. Quickly moving on, infrastructure. There's a change going on in infrastructure as well, and particularly in power and energy. The days of coal-fired power stations are coming to an end. Increasingly renewable power and natural gas is driving the energy mix today, and there is a continued need for new power facilities to serve for that eroding coal and nuclear power provision. Increasingly, we're in a world of energy mobility as well. Liquefied natural gas is being transported all over the world, and providing the infrastructure to actually allow for that is critical, and it requires billions, if not trillions of dollars to make that happen, whether it be pipelines, ships, gasification facilities, liquefaction facilities. It's all required to help move that commodity around the world and serve the world's population. We're also seeing major energy companies outsource in their infrastructure space as well. So what are we doing? We're one of the leading providers of renewable power around the world. We have a dedicated team investing in renewables assets globally, increasingly here in Asia Pacific as well. And we're finding opportunities because, again, those aging infrastructure projects are coming to an end, and governments around the world see the need to promote renewable power. And they're not just promoting it through subsidy as they used to have to do. Increasingly, renewable power is now price competitive against traditional sources of power. So whether it's solar or wind, it's now as competitive to build a solar or wind project as it is providing power through traditional sources. We're building portfolios of renewable power, we're managing those assets, we're adding value to that portfolio, we're optimizing the financing package, and then we're selling those operating assets back to investors who are looking for core operating projects. So we're taking some development and construction risk, but we're able to sell core exposure and take the spread that we get between taking that at early stage risk and delivering core product to other investors. We have one example here, and I'll move on. This is up in Norway. This is a project called Telenas up in Norway. It was a onshore wind farm, and actually in this case we developed this project with a specific corporate off-taker in mind. We partnered with Google to take the power from this project exclusively to power their data center provision in the Nordics. Again, working with a fantastic counterparty, but providing them with green energy to serve their increasing data center needs. And we're doing the same in Australia through solar provision. Value-added real estate. Real estate today is increasingly also a challenging market. Core assets are getting more expensive. So where do you invest? Our view is value-added real estate is where to be. In Asia, we're seeing continued robust growth. We're seeing growth of office returns across the region, and you can see the correlation there with GDP growth as well. So whether it's China or indeed Hong Kong, Shanghai, Melbourne, Sydney, all growing at pretty healthy rates and seeing office total returns grow with them. Market transparency in Asia is also increasing. Often one of the challenges of old was, I don't understand the market, I can't see the pricing, I'm worried about the transparency of Asia. That has changed. You can see most markets are increasing in terms of their transparency today. In Europe, the play that we're looking at here is taking an arbitrage between buying value-added assets, secondary assets, refurbishing those assets, leasing those assets up to full occupation, and then selling them back into the market as core stabilized assets. Many of you may have been hunting for those core stabilized assets. They're now yielding below 4% in Europe. We can buy assets at a 200 basis points premium to that, do that value-added work, and sell them at that 4% cap rate back into the market, and deliver our returns to investors through creation of value through active asset management. So as we've done that in Asia, where have we been? So 3 examples here, I won't talk through all of them. The middle one here is in Sydney. This was called the Zenith. It's in our value-added fund. This was an opportunity to buy in North Sydney in an area called Chatswood. Some of you may be familiar with it, Northshore Sydney. We acquired this building because it's actually 100 yards away from one of the new light rail nodes that is being built into central CBD Sydney. So this has previously been 30 minutes away from the CBD. It'll soon be 15 minutes away from the CBD. We've been able to acquire that asset from a fractious, broken relationship with the previous owners, increase the value of that asset through active asset management, improving the facilities in the building, leasing up vacant space, and now we're in the process actually of selling that building into the market today, and we will crystallize a very healthy return for our clients. In Europe, we've done the same. This is a building in Munich. We acquired it from a core fund that had 30% vacancy in this asset and was worried about that. We were able to acquire this asset, and within 3 months, we'd found a government tenant to fill the vacant space, and actually that government tenant was then looking to completely take over the building, and we were able to agree a lease for the rest of the building once the space became vacant, within a year or so. We actually then flipped this building back into the market as a core stabilized asset, and we delivered our investors a 98% IRR and a 2.3 times equity multiple. Not every asset we do can be a 98% IRR, just to be clear, but this is a great example of where we have had some success in a very core market because we were able to source well, at a discount, off market, transform the asset, and then put it back into the market as a core asset. And then finally, private equity. There's a fundamental shift in private equity today. We've heard a little bit about the buyout funds in the market, and I've talked about mega funds that are increasingly growing in scale. But there are challenges with the buyout fund model that all of us should be aware of. Often buyout funds are increasingly motivated to trade their portfolio companies over 5 or 6 years. And often they'll sell those portfolio companies many times to another buyout fund. You may be in multiple buyout funds, and you may be holding 2 funds that transact a portfolio company from one buyout fund to another. That's something that we think erodes value for investors. Clearly a lot of fees involved in that. And actually we believe there's an opportunity to invest for the longer term. So we've created a long-term private capital strategy that is designed to meet the needs of both portfolio companies and their management who are looking for long-term partnership capital, but also our investors who are looking to find a way to compound returns year on year over the long term and not have to worry about that frictional cost of companies being sold and they having to reinvest every 7 or 8 years into a new strategy. Short-termism, we're trying to address. I mentioned the 2 and 20 fee model. Again, that's something we're looking to address as well. Traditional buyouts still are able to charge high fees because what we're looking to do is provide our investors with scale, $10 to $12 billion. We think that there's an opportunity actually here to provide this kind of solution to our investors at a much more attractive price, capped at much lower fees than the 2 and 20. But most importantly, it gives investors the opportunity to be aligned with the companies they're investing in, and for us as a GP to be aligned with them as well as investors. And then finally, I'd just like to touch on secondaries. Secondary investment is another area that many of our clients have been investing in for many years. Traditionally, secondaries were a little more simple than they are today. They were there to provide LPs in funds the opportunity to sell their position before those funds wound up and get an exit, provide liquidity to those LPs. And that's still the case today, but actually the world's become more complex. Increasingly, secondaries are now being used by GPs to provide liquidity solutions within their portfolios, whether that's taking a top slice to their strongest performing assets so they can de-risk, or indeed restructure their portfolios at the end of a fund life if they wish to maintain ownership and continue to drive performance. we as a provider are looking to help those GPs and LPs with their secondary market liquidity needs in an increasingly complex environment. And as you can see, we're doing that right across the spectrum here, whether that be through traditional tactical secondaries, single LP manager interests, multi-manager interests, structured solutions, or manager-led direct secondaries. We're embracing the complexity in the secondary space, and we're turning that around and providing liquidity provision to our clients, our LPs, and also GPs in the market who need that help. So hopefully that's given you a sense of some of the opportunities that we at BlackRock see in the markets today. It is a challenging world. You need to be cautious. You need to be mindful of risk. But if you do that in the right manner, you can still find a lot of exciting opportunities to drive returns within your portfolio. I'll stop my comments there and perhaps we'll turn it over to Q&A. Thank you very much.